Hello everyone, welcome to today's US Open live webinar. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. It is today, Thursday, June 22nd, 10 minutes before Wall Street opens as usual. Today we're going to talk about the policy decision by the Bank of England, which was due a couple of hours ago, and the central bank reaccelerated the pace of tightening following hot inflation report. That's mostly what we're going to talk about, but we're also going to touch on the Fed and the ECB, and of course, Chair Powell's recent testimony to Congress. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Okay, let's get the ball rolling and let's bring GBP USD in on our screens and talk about what the Bank of England decided today. So the Bank of England had been raising rates conservatively again over the past previous meetings, but today it decided to reaccelerate the pace with a more forceful 50 basis points rate increase, and that is in response to yesterday's hot inflation report, which showed that core CPI jumped 7.1% year over year, in the biggest increase in more than 30 years. And of course, this report came home of the heels of strong labor data, which showed a drop in unemployment and a significant increase in wages, which has been a constant source of headache of concerns for the central bank. Now, the British pound has this continued monetary tightening by the Bank of England has been a source of strength for the British pound. However, as this can now turn into a headwind because of fears around its impact on economic activity, and this is largely what we see here in GBP USD, because as we can see in the highlighted area, there was an initial spike, but the pair quickly raised the gains, probably due to this reasoning that we just explained. The central bank once again was non-committal about future moves, but the truth is that with elevated wages, a tight labor market, and high inflation, it's hard for them to back down. Now, however, the next decision is not until early August, so they will have time to assess a slew of incoming data. Now, in terms of GBP USD market analysis, technical analysis, obviously, as we said, it has been rising on the back of prospects for another hike, but now we see a little bit of a reverse reactions. Reaction bulls are, in any case, in control and have the ability to challenge 1.2948, but we're still a bit cautious as we need for the dust to settle and see where things will go from there. Given this, the raising of the initial gains, there's definitely scope of a correction back towards the 200 period EMA at around 1.2550, 1.2560, but the pair is well protected below that with the daily Ichimoku and other technical support. Now let's move over to Euro USD. It comes from its best week of the year due to the ECB Fed divergence and rose again yesterday as Chair Powell's speech cemented this differential. So last week, just a recap, the European Central Bank had raised rates again and pointed to more tightening ahead, while on the other hand, the Fed, after more than a year, the year of hikes, it stayed on the sidelines. It did not raise rates. And although the dot plot was very hawkish, as it suggests, the upgraded dot plot, as it suggests 50 basis points worth of hikes this year. Chair Powell sort of downplayed that in the press conference. Yesterday, he testified in front of the House of Representatives, and he did appear a little bit more hawkish, but he still did not commit to that 50 basis points of hikes projection. So I would say that all in all, it actually cemented, consolidated this differential between the two central banks. And of course, the Euro USD rose again yesterday. To date, it closed above the daily Ichimoku cloud, and it now has the opportunity to push for 1.1096, a new 2023 high, but we likely need fresh impetus for taking it out. The move, however, is a bit stretched, and we see some pressure today. And this creates hopes for backpedaling, but strong catalyst would be required for daily close below the 200-period DMA and weakness below that level, given the monetary policy landscape seems quite difficult. And we're 3 minutes before the US session still. Let's move to NAS 100, the US tech heavy index. It has come under pressure after the Fed pause or skip or whatever we want to call it. The Fed is probably playing with words a little bit there, and Chair Powell even more so. The recent slide creates risk for a deeper correction towards the 200-period EMA at around 14,320, but a strong catalyst would be needed for a bridge, and there are multiple regions where further correction could be constrained. In any case, especially the Nasdaq has shown incredible strength and has been on a clear bull run, partly fueled by the AI boom, something which we have covered both with written content and through this venue, these webinars. And bulls are definitely in control and can set new highs, although we are a bit cautious for moves above 16,000, and the record highs of 16,771 are still distant. That's it from the tech. Let's round things off with what's ahead. Chair Powell testifies again a little bit later, and we also have more Fed speakers, so we will be closely watching that. Now, tomorrow we expect inflation from Japan. The main one, which excludes fresh food prices, has come down from its 4-decade highs back in January, but ticked up again last time in April to 3.4%. So it will be interesting to see what comes out of the new inflation report. In any case, the Bank of England continues to stay on the sidelines and has not shown willingness to move away from the current ultra loose setting. Other than that, tomorrow we expect UK retail sales sales and a series of preliminary PMIs. That's pretty much it from us for today. Thank you for following. We'll talk again on Tuesday, same time, 10 minutes before Wall Street opens.